How's it going, everybody? My name is Antonio, and I thank you for being here. You're about to watch or listen to a conversation that is general and impersonal in nature, one that will not include any financial nor professional advice of any sorts, but it will likely include a lot of forward-looking statements. So I recommend you watching this with a handful of salt and just proceed with caution and do more research before taking any decisions. That all said, Joe, thank you for investing your time in me today, sir.
Great. Thank you very much for the invitation.
The pleasure is all mine, of course. And Joe, I wanted to talk to you because I was hoping to get an pun not intended, but an insight into how you pick what stocks to invest in. But in preparing for the interview, I realized it's a bigger task than what I had expected. So we'll dive right into it here. But just a sort of an obligatory first question. Can you just tell me a little bit more about your background and who you are?
Sure. Joe Mazumdar, but I'm from Canada, and so I did my undergrad here in Alberta, and then I worked around here in exploration and geology, mostly in British Columbia, the Yukon, and the Arctic. Then I moved myself to Australia, and I worked there also in geology at in Queensland mostly, and in the at a mine there, a gold mine in Mount Isa, the southern part of Mount Isa, south of Mount Isa. And then I did my master's there in exploration and mining at a place called James Cook University. And then after 4 years there, I moved to South America with a major diversified minor. And I spent about 8 or 9 years in South America doing copper, precious metals through Argentina, Chile, Peru, and Ecuador. And then I got married. My wife's a geologist. We had our first kid. We decided, we couldn't keep doing geology, both of us. So I went back to school, and I liked math and I liked finance. So then I went and did an economics degree at the Colorado School of Mines. And from there, I did another, let's say, 8 years doing corporate work, corporate development, market analysis, trading with Newmont, Phelps Dodge, and then I left the States and started becoming an equity analyst for brokerage firms, Haywood and Canaccord Genuity in Vancouver. And then I met Brent Cook on some of my site visits, and then he proposed that maybe he'd be interested in taking over the letter. I didn't initially, but then in 2016 I took the letter over, and I've been writing it and publishing it with my wife ever since.
And that's exploration insights for the off chance that somebody doesn't know. Did you happen to learn any Spanish while you were in South America?
Oh yeah. No, I'm okay. I mean, if you talk to my in-laws, I'm not that good, but yeah, I get by, and I noticed that even when I lived in the States, I got to use it a lot because when I worked for Phelps Dodge, we had a lot of operations in Chile and in Peru, Cerro Verde, El Abra, and then I also used to trade aluminum and copper, and so some of those people were in Venezuela, and so I learning and knowing Spanish in the mining industry, especially when you're America's focused, as I was at the time, is a very useful language to have.
That's something that I've been wondering about myself because I like languages. I want to add another one to my list, and I've been thinking sort of in being indecisive really between German and Spanish. I guess German would be easy because I speak Dutch, but I also speak French, so Spanish shouldn't be too hard for me either. And I want to
Yeah.
do something where it's low effort but high return, if that makes sense.
Well,
So yeah.
that's what we're all trying to do. Like me learning Spanish was sort of like being thrown into the water without knowing how to swim. And
Hmm.
so to have a life there, Spanish was necessary. I'm not somebody that really is very good at languages like my wife is. Like she could learn English in Argentina, not have any association and speak English outside the classroom. but still come out speaking pretty good English with no significant accent. I couldn't do that. But I was forced to speak Spanish, which was great. And I continue to use it at home with my wife's friends. I don't really have any. And it's not something that just went away. I still use it a lot. So that's been very handy. It's nice to learn a useful language, and not something that's just something that you could use once or twice a year. And especially in the mining industry, I think Spanish is very important. But if you want to talk to investors, maybe German's more helpful. So it depends which side you want to talk to. But what I find is when I go out in the field, and the CEO isn't there or nobody else speaks English like their first language, and if I did not know Spanish, there's a lot of questions that I could ask, and I know from their perspective English is not their first language, and when they're responding in the vocabulary that they have, and such that I'm not getting a more robust answer.
Mm-hmm.
And
Mm-hmm.
so when I go down there and I ask them in Spanish, when I know that that's not English isn't their preferred way of talking, then I get a lot more data.
Mm-hmm.
I can say, well, what happened there? And then they start to feel comfortable. And then they say, yeah, but this is what's happening over there. But and you didn't, and then they start being very expressive, because then they go, oh, and then we saw this, and I go, oh yeah, well, I used to work here, and blah, blah. Oh yeah, I remember that. So it's very helpful. It sort of gets you past that barrier with the people in the field. And since I do a lot of site visits and that, for me, it's very beneficial. It doesn't help me obviously in Brazil, and so Portuguese is something I'd like to learn. But yeah, it's definitely in Spain, and that it's very helpful. In other countries, a lot of people know English to the level that they feel comfortable expressing themselves in that language. It's not the case everywhere.
Yeah, it's true. I didn't really choose to learn English. It was just sort of popular culture, I guess. I didn't even get English in school up until 2015 when I went to college. Before that, it was really just popular culture, songs, movies, TV, stuff like that, it sort of happens. You love one show and you put it on repeat and whatever. I used to watch Two and a Half Men, and I knew the lyrics inside and out. And that's sort of how I learned English, and it just happens. You don't really choose for it. But now I'm trying to make more of a cognizant decision, if that makes sense.
Yeah, no, I mean, I know a guy who learned Spanish by watching the telenovelas in Colombia, and when they had the subtitles below, and that's basically how he learned Spanish. And I find watching movies and things like that, that when you're young, young meaning probably in your 20s or younger, watching a foreign film was, a bit of a stressful thing because you could never, it took a lot more out of you. But now I find them, a lot better because I find that I'm so much more focused because I can't take my eye off the screen because I could know what they're actually saying.
Mm-hmm.
It's not like an English movie where I could walk away and still hear what's going on and then come back with your popcorn. You got to just stay there and not move. And I find that that's a better way of learning a language as well, because even if you speak Spanish or English in one place, it's not the same way people speak it in a different place. And so I start knowing the nuances of speaking in Argentina versus Chile, an accent in Ecuador versus how they talk in Mexico. And so I can tell now where somebody's from when they're speaking Spanish to me. But just like normally I could tell, somebody from Scotland versus somebody from Ireland versus somebody from Australia. Now I can do that in Spanish, but that takes a lot of, that sort of feedback, talking to people living there and knowing that. But I find in the mining industry specifically, it helped me a lot.
That does make sense. And then you make a good point on the financial side, because the only mining event that I've ever done was in Zurich, and everybody spoke German. So that also makes sense. But also in Germany, there's a big mining financial industry, if you can put it that way. Yeah. So that makes a lot of sense too. But then again, in Zurich, people also speak French. So if you're necessarily, broad topic. I don't want to make anybody angry watching this because there's already a few comments coming in that this is not a language show, which it isn't. I do want to know how you pick your stocks, like, and also generally how you maybe how you start. Take it from the top. Like, do you take it from top? Like, do you do top down or bottom up research, or how do you find what resource to even start looking into? Is it gold, silver? Like, do you do macro? But tell me all about it.
So, what's helpful about the letter is that, when I worked as an equity analyst, you were driven almost by the bankers in terms of, hey, we can do a deal. Here's the company. What commodity it was, the management team, the asset, and all that was almost like a secondary thing as to like there was a high potential that they could get paid. So when I do this, and what's nice about it is I could do all the detailed work myself and always revert back to it. So in the beginning of the year for the subscribers and myself is that I'd look at a bit of a macro picture as to, okay, what's happening and what commodities do I want to be exposed to? I know a lot of people like to do the bottom up and say, okay, I'm commodity agnostic. I just want the best asset, the best management team, which is also, a great way of doing things. But I find that when let's say the sentiment is negative on a particular commodity or sector, it's hard to fund these companies. And most of what I'm dealing with are companies that are not cash flowing. And so I need the sentiment to be there for them when they need, to go raise money or when they start putting out positive news flow. Does anybody care? And so I need to be in those commodities. I'm not trying to go for the flavor of the month commodity just because when the market's very small, one little thing can tip the market the other way and suddenly nobody cares anymore. And so I like to stick to a little bit more liquid commodities that have a lot more trading and people talk about more, like your coppers, like your golds and things like that. I'm definitely aware, that lithium's been strong, but there's a lot of potential technological breakthroughs that could, supply a lot more lithium potentially to the market. And then I also look at what the end user is looking at. So then, from a demand perspective, who's talking about which commodities do they need? And so the battery thing, the carbon neutral technologies, a lot of debt, blah blah blah. So saying, okay, maybe I want gold for this reason, and I want this stuff for this reason, but then I have to filter the commodities, saying which exposure do I want. And then once I find out the commodities I want to stick to, then I look for, well, what kind of exposure do I want? Production, development, grassroots exploration. And as you go through the stages, once you get to, in terms of management, share structure, and all that, that sort of stuff, when you're dealing with producers with multi-billion-dollar market caps, they're almost already spoken for. They usually have good management teams. They usually have good share structures. They are liquid. They're usually, got decent working capital and capital structures. And that's definitely not the case always for development companies and definitely not the case for exploration. And so management, if you had to look at the spectrum, you need to focus even more on the companies and the management teams, the smaller the company. I'm not saying that a management team in a big company can't blow it up, because there's lots of instances that can happen, but it's probably less often than that can happen in a junior company when they're more dependent on where the next dollar is coming from. And so that on a high level is how I go through it. And then I look at, okay, because a lot more work is required on the exploration stage companies with respect to filtering, because there's so many, like, I don't mind and I don't like it, but if I make the mistake on a geological basis that, hey, they got a model, they got these great people, they're raising money to do this program, and they don't hit, that's geology, that's fine. But what I want to do is filter it that, hey, these guys are paying themselves a lot more. Oh, geez, they have all these warrants coming out in 3 months, that are going to be an overhang on the stock or something. I don't want the reason I didn't make a return on that stock because of something that's not geological. because that's the risk I'm taking. It's not like, hey, if you want a 10 bagger, there's a no risk 10 bagger. If there's a 10 bagger out there, that's because it can go to zero. So you got to understand what risk you're actually going to taking. But I don't want it to go to zero because of the share structure that I missed, because the management team had a problem that I didn't pick up, or there was a social license to operate issue that I hadn't researched. So that's the sort of thing I want to avoid, and that's the work that's needed, the due diligence that's needed. There's not enough due diligence to do probably like let's say somebody's drilling all these holes, and then you go, oh my God, there's already a lot of holes there. So what are they actually doing? That's another, and that's when you dig into, oh, has this thing been drilled before, or is this a new project? Blah, blah, blah. And so sometimes those smaller cap companies take a lot more of your time than the big companies, but the return is what's driving you to do all that work. Because with the big company, if you can make a 20% return with that company, is it worth taking the risk on a development or an exploration company, especially if you don't have that sort of knowledge base to be able to filter the company based on asset location, infrastructure, does this grade work here? Does this metallurgy make any sense? Are they going to get power? Does management know what they're doing? All those sort of things. Is it worth taking that risk? Because you could miss one of those, and your 10 bagger, will go to zero. Otherwise, if you don't understand that, maybe it's better for you to stick with the bigger companies where you don't have to worry about that, and you can just look at the financials. So everybody is different in terms of what they're willing to take on, but that's sort of like a high level what I try to do.
Definitely a couple of interesting things here to touch upon. I hope we're actually going to be able to go through all of them, or most of them, more in detail. And I absolutely agree on what you said, that sometimes larger companies would take up less of your time. I interviewed Kazatomprom, for example, the biggest uranium company, and it took me far less time than what I would normally put into like a 50 million Canadian junior interview, for example. Yeah. And so I definitely know what you mean there. And yet the responses on the interview were great for Kazatomprom, and it was used on some high level stuff as well, which is, was interesting, because maybe I put 4 hours into it or something along those lines. And like on a junior, I would spend 2 8-hour days to figure out what's really wrong here. Who's drilled this before? Why did they leave the property and stuff like that? Before I sort of get ahead of myself, there's something that you mentioned there that I did like, which was about lithium, and you reminded me of lithium. I completely missed that run up. I don't have any positions in lithium, but what if you find something and it's already ran like lithium right now? It's like, something inside of me, as vanilla as this is going to sound, something inside of me tells me to, just stay away. Even though I understand lithium, the case for lithium, there still might be some potential left. But, and I guess to pour this into a question, how do you know what stage or what inning or whatever metaphor you want to use that we're in a given commodity?
Yeah, well, the lithium one is interesting. It's a small market, and so it's got that ability to go up. I mean, this is not the first cycle in lithium. We've had one or two before where it sort of like started, then stopped, and then it started again, then stopped. We're in it right now, a part where we're trying to build up this battery technology, and lithium was one of the commodities I sort of picked because because technology is the big risk with the battery composition, because you could basically engineer a commodity out if you could. And one thing I noted at the time several years ago was lithium was one that was in all the different versions of the battery. Yep. And so I was worried more about your cobalts and things like that. But trying to find one that made sense, because there's a lot of lithium out there, but to try and get a grade from the brines that, a lithium carbonate grade or a lithium hydroxide that could be fed into the battery system, that was really the hard thing people had trouble with. And so what's gone up, which is something that I didn't think would go up that much, is the price of lithium concentrates from the spodumene concentrate from the hard rock. Because for me, that's not a big high margin or technical project, because you're just mining something, which anybody could do, that's got a grade of 1 to 1.5% lithium oxide and the spodumene pegmatites, and then you're saying, okay, well, now I'm just going to concentrate it to 5 or 6%, then I'm going to sell it. And I think, well, that's not much value add. But the price of those had gone up so much because there just wasn't enough brine either coming out, and lithium concentrate was the thing people were producing. And so there was this company in Brazil that was in development. It was well funded, and somebody recommended it to me. I looked at it. It was trading at 52-week high. It's still trading at new 52-week highs. And I didn't jump in because I thought, well, because they were even telling me that the lithium price was too high, and it was going to come down. And so, well, when is it going to come down? That sort of thing. And you get sort of tentative. And then that's happened to me before with another company that had a resource or was doing exploration in Northern Europe. I thought that they had a higher market cap than some other explorers that were doing the same thing. And part of the reason was the management was high quality. They had really strong backing as well. And they always trade, and they were very liquid, but nobody was selling. The owners of the stock were long hold, and they never released much stock, and it was just little illiquid things that would happen that would drop the stock, or these people would buy. But it was always highly valued, big market cap. And then I thought, well, why should I buy this one when I could buy that one? But they ended up making a significant discovery, not at the place that I visited really, and not under the strategic plan that they were sort of invoking to me, that I wasn't interested in. So for that market cap and that plan, I didn't think it made sense. But that management team managed to find something else that made sense. And, now they have, multi-million, $100 million market cap now. So sometimes you may have to pay that premium for management because they're the ones that could, make it through all the cyclicality of the market and always come up with something decent, even though they might not have it now, and they might have it later. Same thing happened with a nickel project in Western Australia. They had a lot of cash, but they were working in an area that I thought, well, that's never going to have anything. And I thought, well, they got cash, you're trading at cash, but what are they going to do with it? And they ended up, doing this big nickel thing in Western Australia, and they drilled it, and they made a fantastic discovery, and now it's trading at about $1 billion. But the initial plan for me at that time didn't make sense. But probably, when they did make that initial discovery, then that's really when you got to decide, well, do I jump into it now? Is it a legitimate discovery, that sort of thing, and that's really where you can make your money, but it won't be coming from a penny to $5 or $10, but it might be coming from $1, but still a potential decent return.
Sure, but so how do you know if it's not too late in the specific commodity cycle, like it is with
when you're into discovery stage, probably the commodity matters less if they find something significant, because basically what we're trying to do, or what I'm trying to do, is find something that I think a major or a producer would purchase. And so then I have to think about, well, what are they looking for? And, if I went to a restaurant, here's the menu. So I'm not buying for myself. I'm buying for that person that I think is going to eventually take that company over. So then I'm looking at the menu from these companies, these juniors, to say, what do I think that they have that guy in the table number 5 is going to want? And then I got to see if it works for me, because I don't own the asset. I don't own the royalty. I don't have a stream on the company. I just own shares. And so how they manage the share structure is as important as how they manage the asset development, in terms of progressing through exploration, how they drill it, the technical knowledge. But that gets divided by that denominator of share structure. So if they're tell me that they don't really care about share structure, if they're willing to fund themselves with full warrants, if they're, they got a big old warrant overhang.
What is it? I'm
They
sorry for interrupting here, but that's an important part, I think, too, because I recently had an interview with someone who had like a 45% overhang. So 45% of the fully diluted shares was in options and warrants. I thought that was rather high, so I pushed back a little bit on it. And the person I was interviewing didn't really like that because they thought it was a normal thing. What is a sort of your cutoff there?
Well, I mean, if you've got that kind of overhang, it can be significant. But what I do is I look at the prices of all those warrants and options, and where I came in. And so if some of them are way up there, then that's fine because they'll all run out of the money, and it's not really an overhang. But the problem is that those shares that come in, let's say, when somebody does a reverse takeover or an IPO, who's got the cheap shares? Are they long-term hold or are they sellers? And so if a company is a liquid, it sometimes doesn't matter how many, like if it's a big volume, because it's still going to impact the share price. So it can come out in dribs and drabs because it doesn't trade very much. Every time they have good news, people look at a liquidity moment and say, okay, this is my ticket to get out of this, because even though you think it's well valued and has potential to go up, that person is in at about the fifth the price, so they've already made 5 times. They don't care, they just want out, move on to the next one. And so then you're sort of saying, well, hang on a second. And so I got to go back and say, who's actually owns these shares? And usually the company would say, oh, these are trustworthy people, we own them, blah, 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 blah. But then I look, okay, you've got this brokerage firm and that brokerage firm, and then these guys have their own clients. And especially in this current market that's very volatile, when somebody books a win, they'll probably take advantage of it as opposed to holding it.
Yeah.
So
pretty much the alternative of booking a win in this market is pretty much booking a loss. So, which one do you take?
yeah. So I don't blame them for, making their money or anything like that. I just have to do homework to know that, when that overhang is coming. And so that's a timing issue to buy it as well. If you still like the asset, forgive the company for their share structure they might have inherited from somebody else. Then you say, well, when do I buy it? And then you look at this big package of warrants that are coming out, let's say in January. I'll wait and I'll see the reaction once those, because usually the reaction happens before, as these people buy options to guarantee the price of the warrants when they come out. And that's the short position that develops. And so that's something else you want to watch, is the short positions in these companies. And I did that for subscribers, and you showed, how the short positions have grown in a lot of these companies just year to date. And that can be an overhang as well. And it shows you the sentiment as well has changed significantly in 2022 for a lot of resource stocks.
That's a tricky part too, I guess, because it's the newsletter that you run is called Exploration Insights, and oftentimes you would hear talks about, oh, you just have to be a contrarian, and it's a good thing to say, I guess, because it's also the path of least resistance for your mind. Like, it sounds easy. Oh, I just have to do the opposite of what everybody else does. But that's maybe not always the case with these exploration companies, because if you're buying when nobody else wants them, and they run out of money and they have to dilute you out of your ownership of the company, basically, because they don't have money, then yeah, sure, you bought it when nobody wanted it, but then are you really making money? So I guess that's also something that you have to pay attention to, their cash position, I guess.
Yeah, well, that's the big risk you take right now, is that it's cheap, but it could get a lot cheaper. And then, maybe they have to offer a full warrant at a 5-year timeline. And then you're thinking, wow, I didn't get that. And they're doing it at a discount as to what you bought in the market. That's the risk you take by not selling before, is that, how do they control their budget now? Do they still keep doing what they're saying they're going to do? Because that, let's say, first quarter next year, they've told you as well, and you can see their financials, they're going to run out of money. So what's the market going to look like then in March? And will it be up? Will it be down? And will it be trading higher? And will the sentiment be positive? If you think it's not going to be there, that the Fed keeps raising rates, and everybody else looks at gold like, the gold price hasn't really done that badly, as most commodities look a lot worse quoted in the US dollar than they do quoted in other currencies. Like even in China, I think the copper price is down like less than 10%, but in the US dollar quote for copper, it's down 20%. And that's because the US dollar is up about 15% year to date.
Yeah.
So it's not only just looking at the commodity price quoted in one currency, you got to look at, what's happening everywhere else. So the sentiment, but if all the investors that are driving the share price of the stock you own are US based or North America based, they'll have that opinion. If it's European based, they might think something completely different. Then they go, yeah, gold's great. Look at our currency. Gold is where I want to be. And silver gives me even better leverage. So silver is where I want to be. That sentiment might not be there in the US, which it's not. So they might be more negative on it, whereas the Europeans might be more positive on it. So it depends on the commodity. It depends on the investors as well. So you might go to a conference in Toronto and it might be dead. But you might go to one in Germany and it might be really good because they're more. They have a more negative sentiment maybe about where their economy is going and what faith they have in their government in that, and so they want more gold exposure. So they think the gold price should be going up higher, not stagnating. And the gold price might be lower in US dollars, but there's a strong chance it might be going up in euros. So that sentiment also is not global. It can change, just like everything can change depending on the perspective. And if you don't have that perspective and you just take it from one perspective, you could miss out on what's really happening somewhere else.
That's an interesting way of gauging sentiment, I guess. What other ways do you use? Do you have a tool or a screener online? I know there's stuff like the BPGDM on gold for gold miners.
Well, I check a lot of the financings and see who's getting funded, and see, like, you can measure funding, gauge it. You could say, well, let's take a spectrum of a financing, let's say for a non-cash flowing junior. Prior to March this year, a lot of these companies could raise money at a small discount, meaning 10%, do a bought deal, not issue any warrants. That's great.
Yeah.
That's perfect. That's your ideal. Because you don't even have to be involved in the private placement, but you could buy it in the market without the 4-month hold and say, yeah, I got a decent bargain here. Fast forward, 6 months, and now private bought deals are harder to come by without a half warrant or a full warrant, and the same 10% discount. And so if you look, that's what's being offered to this gold junior, but hey, this copper or lithium company it didn't have to issue any warrants. It's almost getting it at where it's trading right now, and it's got a bought deal. So that's impressive. I mean, Cameco, a uranium company, they did over $600 million in a bought deal. And you name me a precious metal company that thinks that it could do a bought deal for that. There isn't one.
They did a big discount to the market price, though, wasn't it? It's like 15%, 20%, maybe.
Yeah, and I think, but that is a bought deal that's guaranteed, and they needed the cash because they wanted to do this deal with Westinghouse. But I don't think that market's there for any precious metal company to even ask for that kind of thing.
Especially also because in that particular deal, Goldman Sachs then turned around and bought some of those shares, basically. So they did the bought deal. That aside, they now have an ownership in the company. I guess that also tells you something about the sentiment.
Strategically makes sense, but then it's got ramifications for the industry. It sort of says, well, hey, uranium, you produce uranium for the downstream, and now you're going downstream because you think that the margins there are attractive. And why are they attractive? Because now the Russians' segmentation about them not being able to serve these nuclear power plants is gone, and somebody's got to fill the gap. Yep. Here I come. But strategically, that's sort of saying, well, they see more upside risk adjusted upside in the downstream than they see in buying a whole bunch of uranium developers right now.
Mm-hmm.
Whereas UEC, they purchased Rio Tinto's
Rough Rider.
Rough Rider asset for about a fifth of what they bought it for, whatever, 5 or 6 years ago. So one person sold a development asset, another person bought it at a much more reasonable price, let's say, but that wasn't Cameco buying it.
Mm-hmm. Yeah.
And Cameco's got all the processing facilities. So if anybody had leverage and probably could do it cheaper, it'd be them. Instead, they raise money to do a big deal with Brookfield Asset Management to do this potentially phenomenal, deal on the downstream. So that's somebody, looking farther ahead potentially, because they might be worried. Okay, if I do another development asset, then I'm going to be stuck with the capital for it. Capital's escalating. There might be a better opportunity here to work on the downstream and in terms of a risk-adjusted reward. And so whenever you see these sort of deals, that's another gauge of sentiment. So who's doing deals? What do those deals look like? So we haven't seen a lot of M&A right now in the gold sector, except for Goldfields Yamana. But I just looked at a press release on Goldfields Yamana where the Yamana chairman is sort of saying, "Hey, we're not changing the deal." So if they're saying that, is that because Goldfields is telling them that they would like to change the deal and they're not accepting it? Or because their own shareholders are sort of saying, "Hey, it's not worth this much. You shouldn't do it." But still, if they don't and break the deal, I think that's a break fee of like 400 million or something like that.
Mm-hmm.
So that's also cash out the door in an environment where you don't want to really be ditching cash out the door for nothing. So it's an interesting market right now in the gold sector because we're seeing margins compress because the gold price is stagnant to flat, but their costs are going up. And so they're making less money. So they got to control their funding more. So they're going to pull back on capital.
Mm-hmm.
And they're not going to buy things right now, but that cost increase is throughout the industry. But hopefully you're in an industry where at least hopefully your revenue is riding at the same level so your margins stay constant. Right now, it's hard to find a commodity or a producer right now that's seeing expanding margins.
Sure. Yeah. That's a good nod actually to something that I've been recently thinking. You hear all these people saying "great is king," and I used to believe that because it made sense. But then, from having spoken to many executives and some of the other experts in the field, what I often hear is I guess you can make a phrase saying that "great is good, but margin is king." As what you're investing here essentially is what you're investing in essentially is a business. And as a small business owner myself, I own a small bakery slash cafe, whatever, with my wife, and it's really the cash flow margin that we focus on. And although we have barely increased our prices, like we had to increase obviously the prices of orange juice and stuff like that, but our cash flow margin has also been decreasing, and it's much worse in heavy industries like mining, where they use a lot of oil and all these type of materials.
Well, it's not only like oil, definitely, and they're sort of seeing that moderate right now, but labor. The labor availability is very low. Labor costs are, hitting them very hard, and productivity, because in some places COVID's still an issue, and so people don't show up. They don't show up for 6 weeks.
Yeah.
And if you exacerbate that with labor availability, and so say, well, these three guys are really the crux of how we do this, and two of them aren't available, and we can't get anybody else, or we pay a consultant twice as much. That's where we get, labor rate escalation, and lower productivity. And that's what a lot of people are dealing with. And if you have a smaller, like your bakery, which is maybe just you and your wife and a couple of employees, you might get less of that risk of labor rate escalation versus somebody that's dealing with 1,000 employees or more.
Of course, yeah. And I was actually I'm exceptionally lucky because I was able to employ my mom and my dad. And so, their labor costs are have generally stayed the same besides the obligatory because we have to adjust their paychecks to inflation in Belgium. We have to do that. And it's been over 10% here, so there is that adjustment. But yeah, I just make him work harder. Uh, what are some red flags that can pop up very early on in your research process, Joe? Like, well, you're looking into a company, you're sort of like, okay, you like the commodity, you like some of the basics on, you've gone through the overhang and all the basics that we talked about, cash and the management. What are some other red flags? Maybe some stuff that beginners might miss.
Well, for me, I mean, the biggest filter is easily the management team. And so I can filter that pretty easily, and I just won't touch a company. I don't care what the asset is. And so that's a lot of work that I save myself because I know eventually I'm going to get screwed and my subscribers are going to get screwed. And they'll ask me, why did we do this? And I say, well, I knew that these guys were kind of shaky, but I thought the asset was great. So I don't go down that path anymore.
But how do you know? Because it's I've seen that a
History,
lot. Managements that
history,
yeah. Well, so that
history.
but for example, I would know that because I know someone and they know someone, and then that's how I know that that's a shady person. But if you go to the website, they obviously have 170 years of experience and they are
Yeah,
the
they
best
all they
person that
all
you
got
know.
170 years. They all were responsible for some of the greatest M&A
Yeah.
transactions, and they all, found everything and everything like that. But as you get more involved in the industry, and then you have a little bit of a network of people that and if it's somebody you don't know, some of them will tell you, well, stay away from that person because X, Y, Z. Another great filter is to go through the IROC website and just, type the person's name in, put in IROC, and then see if they're being investigated or have ever been investigated for something. So that's another way of quickly finding out, something that doesn't make their website. And what I find out about the websites and the presentations is what if I don't know the company, I don't know the asset, it's what they're not telling me is what I focus in on. So if they're talking about how big the project is, then I'm worried about grade. If they're talking about, how far they are from civilization, and then I worry about infrastructure. If they tell me let's say, how great their community relationships are, then I'm wondering, is the asset any good? Yeah, it's everything they don't tell me. Like somebody who's got a presentation and the first 20 slides are on the commodity
Yeah.
and not the asset. So that tells me something.
Hmm.
If I'm taking the meeting, they should assume that I'm okay with the commodity. I can ask some specific
Yeah.
questions about what I'm thinking about what's happening, and if they can respond to those, that's great. But I don't need a big supply demand. I leave that to the Vale, the Rio Tintos, the BHPs, and those are the ones I would read about what's happening in their specific market. Norilsk was really good until they dropped out of the picture. Uh, but but I don't need a junior to tell me about that.
Hmm.
The fact that you're in this commodity says this is the one you picked. That's fine. And the fact that we're having this meeting is I'm okay with the commodity.
Hmm. Do you
We can
monitor
work
maybe
with
their
that.
social medias too? Because I've noticed that too, where a junior would start doing, they would get a little bit confused and maybe do memes, and then they would also, they would publish facts about their commodity and stuff like that. But that's, yeah. Do you monitor that yourself? Like, do you go on their Twitter profile or something else?
Uh, yeah, that's a lot of time to spend. But when I do own a company, I sort of, maybe I follow that CEO or the company. And if I follow the CEO and then he's on Twitter all the time, commenting on everything, then I wonder, well, where do you find the time?
Hmm. Hmm.
Why don't you focus in on your own work? And because that, and then that also hits me when I see the CEO. So I look at the CEO, he's the CEO of this company, he's on the board of this company, and then I look, and then he's on the board of this company and on the board of this company, and then he's the technical advisor of that company, and then he's starting a new company over here. Then I'm thinking, well, hang on a second. I sort of bought a share in this company for assuming 100% of your time is going to be spent on this. But I bought this share and I'm getting maybe 10% of your time. Like I don't have a problem with you. I think you're like smart, blah, blah, blah. But it doesn't seem like you're the one that's running this company, or you're not fully aware what's happening with this company. And I need that kind of dedication. And I don't think I'm getting that. So that's one issue. A company that's got 20 technical advisors on it, that found everything and stuff like that on one of their slides that sort of says like, Jesus, don't you have your own people that could do a lot of this? You have to depend on this many technical advisors. Because I'm not as impressed anymore with having that list, because a lot of these technical advisors, that are doing this sort of like serially, let's say, they dilute their own name. So then I have less time, or it doesn't say anything to me anymore.
I know what you mean. Yeah, exactly.
If somebody only does it once or twice, that's fine. But if they're doing 20 different companies and then you're trying to sell me that they picked your company, it doesn't mean anything to me anymore.
Mm-hmm. Yeah, right. I've seen that with some big billionaire Canadian investors who shall not be named, who also, they would have their name like, oh, they own 25% of our company. I'm like, they also own 125 other companies.
Yeah.
Literally.
Yeah. But also, and this is a good point, is that it is also like when they do buy these, like let's say a major, like I used to work in Newmont, and we had an equity portfolio that I sort of helped manage for a little while. We would sell somebody an asset, okay, and a junior company wouldn't have the cash to pay us, and so we would end up owning 10% of the company, or 19.9, whatever, and then they pay the rest in cash. And so a company that tells me, well, Newmont owns me or whatever owns me, then I say, well, okay, why do they own you? Is this a proactive investment, or was this a divestment? And that's the first thing I ask. Like, who bought your shares and who did you give shares to? Because that's sort of saying that they're walking away, but the only way they would have preferred cash, but you couldn't give them cash. And so, to buy the asset, you had to give them shares. But they've divested themselves of the asset and ended up with your share position. So that technically, if they're out of that project, that's an overhang, because eventually they'll sell it. That's what I used to do. You'd put a notice out to the company, you'd phone them up and say, you know what, we're going to sell that block. Find me a buyer in a month or so. And if not, then I'll slowly start to sell. So that's another thing you got to know when they say, oh, look at who who's owns my shares. But on another note, right now we're dealing with a lot of volatility and things like that. Share structure is important also when you say, well, look at all the important people that own the stock that are very wealthy, and this is a small proportion of their wealth, and they are like the project, they like us, which is all great. But you as an equity holder, how do you buy this? Because it hardly trades. It's basically a liquid. And so are you going to buy, 10,000 shares? Are you going to buy 1,000 shares? Are you going to only be able to buy 100 shares? And you got to do that over 6 months or whatever. That could be an issue. So liquidity is important. In terms of you getting into the stock, or if they do a private placement that you, as an accredited investor, can enter into that. So I don't like private placements with respect to, I'm going to get it really cheap. I like them more in terms of fixing the cost at one point. I try to avoid them because of the 4-month hold in this volatile environment. And also, I don't really care about the warrant. So I almost think opposite is, if they issue a warrant, I'm less interested, because they had to issue the warrant because there's something wrong with the asset, or management was weak on negotiating the financing with the brokerage firm.
It's a compensation for risk, right? That's what a warrant is in the end.
Yeah, but it's almost like to get certain people into it, you got to bring them in because they're not convinced the asset's that good.
Because
You
that's
know,
how they're known. Yeah, some people just
yeah.
love their warrants, man.
But if you have a lot of demand for your stock, you don't have to issue that warrant.
Mm-hmm.
So you could sort of stand back and say, well, yeah, well, you want a half warrant, but these guys will do it at zero warrant and a 5% discount. So if you can't match that, and give me like no discount, I'll take you guys, but otherwise I'm going to go with them. And so demand, is sort of reflected in the terms, just like in price of the actual financing, and that's what you'd like to see. I'm not a big fan of convertible debt, which some companies are taking on. And one company that we own the portfolio did that, and I was not very positive about that. But these people they had these sort of idea of where they wanted to be, and they kept funding their program, and then in the end they were handcuffed and they had to do it. Is that a good time to say, hey, let's cut back, wait for the market to turn, and have no news flow? I don't know, because they were waiting to sell another asset, which in this market was harder to do.
Mm-hmm. I know we can probably make a whole video series on the geology part too, because it's well, we probably should one day. But I mean, I'm obviously down for free content, so I wouldn't complain. But maybe to put this into a nutshell, maybe what's your main tool or your favorite metric or whatever when it comes down to judging the geology of a product? Like, is it grade? Is it tonnage? Is it metallurgy? Is it something else?
Well, I mean, grade and tonnage is just like the highest level of knowledge, but then I need to know what's in that number. So then I dig into, like, what's the cutoff grade? What are they thinking? Is this open pit? Is this underground? And then if it's open pit, is it a milling process, or is the ore refractory? Is this heap leach? Like, if we stick to gold for the time being, and then if it is underground, what kind of throughput are they planning on? So if you have high throughput, and potentially you're thinking that you're going to get this grade, usually that doesn't happen. Either it's low throughput, high grade, or high throughput, low grade, because you got to take a lot of internal dilution and potentially some external dilution. And so how realistic is that resource? And then it's also about the resource estimation methodology. How did they estimate it? Who did it? So is the person that did it respectable? Do they need the money as a consultant, that they would be influenced by the company? Or are they more concerned about their own reputation, such that they'll tell them exactly what they think is right?
Mm.
So that for me is very important. So if there's a resource company that I know will give the company what they want, and that's why they picked them, then that's a resource that I hold in less regard than somebody who said, I think we have a really good resource. Let's use the people that the majors use. Let's use those people. Let's use the people that the banks use, because they're looking at it from their own reputation. And then if you do go to debt and need debt, or if you do have, want the suitor to look at your project, they don't have to do the resource again, because you've already done it with the people they would have used.
Mm.
And that for me is very good sign that that the management knows what it's doing, and they think they have a quality resource, and they've confirmed it with the people that have an independent sort of bent. If people put out a scoping study, which is obviously the best any project is going to look, with a firm that tends to blow out its capital, and that sort of thing, and sort of makes a project look better because it skinnies the capital such that the internal rate of return looks a lot better. That's another issue. But getting back to the resource, then I look at something called the coefficient of variation as well. So I look at the grade, but then I think, okay, how volatile is the grade? How variable is it? So if the grade is very variable, then you need to drill a lot of holes to make sure it's real. and that could cost a lot of money. So a lot of people, stick to indicated, obviously, rather than measured for underground. I've seen companies that have a lot of issues with underground deposits because they tend to think that they have a high quality deposit in the indicated category that's worth going underground on, and then they find out it's not there because the drill spacing wasn't there, had problems with internal dilution that they didn't take into account, and then the mining method that they used, the geotech was bad such that it fell in, and then they got a lot of external dilution. So when you talk about grade, underground projects definitely on a resource basis will show you that grade. But the problem is that if you don't have any underground development, it's hard to put it into the indicated category or put it in reserves.
Right.
Because the underground development really gives you an idea, a really good idea of the underground conditions. If you don't know that going in and then you go underground, that's a big risk you're taking as the company, but also obviously as a shareholder.
I also hear some of these things, and it's nice that you're bringing this up, because I would hear people saying like, oh, just simply, if it's underground, don't even bother. Like, everything is going to go wrong, and the chances for at least something substantial going wrong are very high, so don't touch it. Is there something for you like that? Like, is there maybe a deposit or a topography or something that you say this is a no-go for me? I don't know, let's pick maybe something trendy, Carlin style type mineralization, or a red lake, something like that. Let's say you see a Carlin type being touted and you say, nope, I'm out. Whatever you're saying, I'm just not going to buy it. I'm out. Is there something that you just weed out immediately?
Well, okay, let's say it's a red lake. With Rubicon asset and the high variability of that one, that had let's say a lot of these deposits with low variability would had coefficient variation of like 2 or 3. you know Rubicon's Phoenix project was, I believe, 17. But Pretium's Brucejack, which got taken over by Newcrest, had like 25. That's why a highly respected resource modeler, Graham Farquharson, said that there's no mine here, because he couldn't figure out how you could actually calculate a resource based on the variability of where the gold was. It was highly unpredictable. But as they mined it, and Newcrest got more, I guess, comfortable that they could meet their production guidelines, they bought it. But it was always an asset that people were on both sides of. Is it real? Is it there? But Red Lake's the same issue. The grade variability is very high. And that's basically where a company like Rubicon had its issue. Eventually, what Rubicon became, I believe, Battle North, they got bought out by Evolution, but mostly that wasn't for the asset that they were trying to mine, but for the plant that was permitted that they already had in the infrastructure. Pure Gold probably is the latest, to suffer with the grade variability in that area, and so they could come out with a great grade. It's underground. Quality people. I've known the CEO. I think he graduated a couple of years ahead of Ian in Alberta. He's had a lot of experience in the Red Lake area as well. And so you could go there. But the problem is that people can't change geology. Doesn't matter how smart you are, you can't change what's there. And so I never touched it, because I thought, well, I don't know if this is real. They can believe it, but I'm not sure it's true. And so that for me was highly speculative. And so then they had a preponderance of issues with development, and then with grade, internal and external dilution. So in terms of underground, no, I don't say, hey, I'm not going to touch it. I definitely look at the type of deposit that it is, in terms of will it work or will it won't work. When you see, okay, hey, it's got a really good thickness, it's very continuous, and then it could be mined underground, with a bulk level method, sub-level open stoping or something like that, and you could drive down the cost. Then I'm more interested, especially if the people doing it have a lot of underground experience in that specific area. That helps as well. Variability and knowing where the gold is and stuff like that. And it's also, if there's already underground development there, that helps as well. So the conditions, that's vital. And that's something that happened with Gatos Silver as well. when they went and developed that mine. They had a lot of high quality reserves, like all the way into measured, but they had no underground development. And usually companies that don't have a lot of underground development never state measured because they don't have enough underground development to say that will actually convert. And you have to really do a lot of tight drill spacing. And so it depends on the deposit. With respect to Carlin, the underground mining conditions can be bad, like the deposit that First Majestic bought, which is also double refractory in Jarrett Canyon. That was always a problematic deposit. But if you can get a decent Carlin deposit, Barrick's made a lot of money down there. So I do own a company that's got those kind of Carlin type deposits. I really like the Geologist. I think they know what they're doing. They've got a lot of Barrick experience on the management team that have mined these types of deposits before. But the issue becomes, if you're going to mine refractory sulfide underground ore, it's got to go somewhere. And so the problem with toll treating it with only one buyer, which would be Nevada Gold Mines, your probability that you'll get screwed is pretty high. They sold an asset to Barrick. We got a deal with them to treat the ore, but also they bought an autoclave to treat their own ore eventually. So I think that's a good game plan for how you want to deal with Carlin type deposits, because obviously there's less and less oxide out there to heap leach, and eventually you'll hit the sulfide. It depends on the deposit, obviously. The people matter in terms of, and then the technical reports, digging into the details of the technical report and finding out, is this actually going to work? And that's the way you take your chance on underground. Open pit is easier to mine, obviously, but the issues with open pit right now is with the ESG footprint of open pits. The waste, is it, acid generating and things like that. They can be less difficult to operate, but they can be more difficult to permit.
That's true. It's by the way, I'm not picking on Carlin type deposits or whatever. I just know
it's
kind of trendy.
I get it.
Yeah, that's just been kind of trendy, and when something's trendy, you can also use it to the disadvantage of retail investors. That's why I sort of brought it up. But I'm not picking.
Yeah, but what we got to understand is Carlin types of deposits are in Nevada, and there's a lot of infrastructure in Nevada. To take that kind of deposit and do it somewhere else, you got to understand that you're going to need, especially if it's sulfide, a lot of infrastructure, because these are refractory deposits. They need autoclaves that need a lot of power. And so if your infrastructure is in there, then, Donlin is not a Carlin type of deposit, but the metallurgy, the gold is refractory. And so that requires a lot of power. And unfortunately, Donlin is remote. And so it's got a big capital number. One reason that, it's been sitting there for such a long time because of the upfront capital number. And in this kind of environment, what I think is probably a good idea is when you see these big capital projects, you probably want to take a step back. And that's sort of like what Newmont is saying right now, is saying, like, we're not going to go gung-ho and develop all our projects in this environment to get that exposure to escalation. So we're going to take a step back. I worked at Newmont when we were going through a period of capital escalation where we would, like this one project that we had was a power plant. It tripled in terms of the authority for expenditure to build it and what the final number was, because of the labor rates that happened when we were building it. You either build it on time or you build it on budget. They built it on time, but it was 3 times over budget.
Is that maybe something that you use in your valuation or maybe determination in terms of, maybe I want to ask how you determine what a fair price is to pay for a certain deposit? I guess it's easier if a project has enough economic and financial data on it, like if it's got a PEA, but what if it doesn't? Well, if it's pre-PEA story or even of an exploration story, like some of the ones that you've been vocal on recently. Well, how do you determine what to pay? What was too much? What's too little?
Yeah, the thing is that some of it's, you look at the comps, the comparables in that area. Be very specific. Don't do a generalized like evaluation. But if you have very little data, then a rule of thumb might be the enterprise value per ounce. But granted, all ounces aren't created equal. And so what you want to do is look at that specific type of deposit. Like if you're saying, oh, my project's an open pit heap leach in the Great Basin of the US. And so what I would look at is other projects in that sort of area trying to do the same thing, open pit heap leach. How do they compare? And then look at the M&A in the area to see what was the last acquisition, what did they pay on a per ounce basis, and then how does that asset compare to this one, and is it an apples to apples comparison? And to say, okay, well, if this project is as good or better, then this number should be a decent number because it was done over the last 2 months or whatever, and try to work in it that way. So you got your geographic constraint, you've got your technical constraint in terms of open pit and all that, and then you can sort of do a comp around that. Don't try to compare an EV per ounce to your project versus let's say one in Kazakhstan or something like that. There's no point. And you might be diluting the value because there is a tendency for some geopolitical jurisdictions to get a bit of a premium.
Yeah.
So that's the issue. So yeah, right now, I would say that if you do that kind of high level stuff and don't have the economics and all that, then it's more problematic to do. But then you can refine it more by selecting specifically assets that make sense.
But even then, this is actually something a topic that I've been pondering myself, because it seems like biggest opportunities for retail investors happen when the fundamentals of the company or the project or whatever decouple, to use a trendy word, from the stock price, right? Or vice versa, actually. But in the same time, it cannot be as easy as to just pick the project with the best economics, right? Because if it were, and if the only thing you had to do as a retail investor is learn how to how to read financial statements or financial reports and deposit economics, we'd all end up buying, bidding up the same stock basically, which would make it fairly valued or even overvalued in some cases, and there wouldn't really be an opportunity there because there's no inefficiency in the market, I guess. So I don't even know if there's a question here, but it's just sort of the difference between a good company and a good stock. There seems to absolutely be a difference, and it's not just as easy as to just pick the project with the best economics. What are your thoughts?
If you pick a fully valued company in your head that's done very well, and even in this environment, let's say it's trading at 52-week highs, then you say, well, if it gets taken out, it might get taken out because these guys aren't going to build it, and they don't want to build it, and they don't want to do the detailed drilling because that's really not going to add much value maybe to that asset, but they would like to sell it. What did they come in at? What would be that final price that they'd be willing to take to sell it? What are other ones trading at? But then you say, well, what are big companies looking for? It's these kinds of assets. How many are there? Very few. And so this might get bid, but it's not going to be like a 50 to 70% premium from here. So you're almost taking like a lower risk, lower reward investment there, and just saying, I'm going to buy it because I like it. I like the people. It sounds like it's going to get taken out in about a year. That's my investment timeline, and I'm hoping to make 35%. Done. So you go in there with an investment thesis, and that's basically what I try to do for all the subscribers. So when I buy something, I've got, what do I think is going to happen here? And then as I get the news flow and what's happening in the background, the macro that's filtering down for these companies, financing risk and what have you, and what's happening with the suitors, is that I say, well, this is changing. So either this is a decision point to say, do I keep holding it because it's really cheap? Or is this the time to say, I'll sell this, even though it's cheap, to say, I bought it at $1, I'm taking out my 50 cents, but that 50 cents in this company might have a chance of going to 30 cents, but it could double, but who knows? Or do I take that 50 cents and guarantee that I got a lower risk chance of making a 40% return on that 50 cents?
Mm-hmm.
That's really the decision that you got to make.
Mm-hmm. When do you think is the best time to buy a stock in the mining space? But like, is it right after the discovery? Is it right before it? Right before production? Our mutual friend Lobo Tigre speaks of the PPS, pre-production sweet spot. When do you think is the best time to buy and then the best time to sell a stock? I think they say something like pre-production sweet spot up until first pour, and then you're out because that's sort of the least risk or something along those lines. What do you think?
Yeah, I mean, the thing is, I guess it all depends. I mean, right now the market for financing is a big risk out there, and so pre-production exploration, you got to be confident that these guys have enough working capital and have access to capital that could take them 12 to 18 months, especially in the precious metal sector. If they don't, then there's a good chance you'll be paying less for it later. And it's hard to pick the absolute bottom for anything, but that's a decision you got to make. So when I'm in the precious metal, companies that I'm looking at or own, one reason I did buy them is because they do have good working capital positions. They know how to manage their money, and they have access to capital. They can go back to the same shareholders, or they have a strategic shareholder that they could bring in, or they have relationships in the industry that they could bring in a strategic shareholder. So that right now is a big risk in terms of the grassroots guys. I don't know if there's a tried and true buy it here and sell it there, but obviously, some people swear by, post discovery, you drill that hole, buy it, but then I'm always sort of like, hey, it's up 50%, is it just going to go down 50% after they drill the next hole? Does this really work? And then you got to look, were there old holes here? And did they just re-drill an old hole? And then the other hole doesn't have anything. You don't want to get piped in by that. And that's reflected in the management team. Would that management team do something like that? Or are they more legit? So I would say, right now it's hard to buy that $20 million market cap company saying this is really cheap compared to this other company, because right now, that market cap, it could be 10 million in 6 months because they have to go back to the market and dilute their share price even more without changing their asset base. So it's a difficult market right now, but it's definitely one where in the precious metal sector, especially, is that, like a friend of mine says, is that it's such that everything's getting dragged down, most things, let's just say. And why buy, let's say, chuck steak when you can buy Wagyu for the same price? So that's really the work you got to do right now, is if you got that head and saying, this is a company I really like, they're in a great jurisdiction, I think they got a great asset, I'm just going to watch the share price. Once it gets to this level, I got a little alert, I'm going to buy. And it's liquid enough that I could do that without changing the price. So those are the sort of things people, I think, right now in this current market should be looking at, is to say, okay, what do I really like commodity wise, especially in the precious metal sector, where you could say, well, hey, I think it's been, really hit hard. I don't think the gold price is going to go much lower, and I think it's going to be better. And this is an asset I think people will want because, it's got great people. I think they can manage their financing. They know what they're doing technically. They're in a good jurisdiction. They have the social license to operate. So you can check a lot of boxes in the current environment and get it for a reasonable price. And that's what we're all about, reasonable price. You might not get it at, a ridiculous price, a bargain price, but it might be a reasonable price given all the check marks you can go in already ticking, knowing historically it was trading much higher with less knowledge of the asset. Now they've put out an updated resource. Now they got more drilling, now they know more about the metallurgy, but now they're trading at half of what they were trading before they knew all that, so and it all was positive, let's say. So this is really a good environment for that. I think.
You mentioned precious metals a couple of times today. Is that is that your main focus? Like, is that the biggest part of your portfolio today? And maybe if you feel comfortable talking about it, I'd also like to know what sort of your breakdown is in terms of metals that you're exposed to in the portfolio.
Yeah, I mean, I guess it's mostly been precious metals, but I've been over the last 2 years sort of migrating to more base metals, specifically copper and less so nickel, because I've had that macro 2 or 3 years ago. And so anything new was mostly in base metals. But if I see a good precious metal stock that I think is, sitting out there, I have no problems buying that either. The problem right now is that argument has to be very solid. It can't be based on the gold price. It's more about this is going to get taken out. This is one that is going to happen, that sort of thing. And so you need, in this market, you definitely need a plus, I don't know, 12 to 18 month at least sort of investment horizon, and potentially a little bit longer for some of
That's
them.
precious metals that you're talking about, right? Because base
Yeah,
metals, I
yeah.
guess, with China going through this short-term pain, I guess you got to have a longer term horizon, right?
Yeah, or not, because some of these ones, because there's more money right now, because I was talking to a guy who was looking at a copper asset and trying to raise money, and he was saying that he had no problems raising money. So there's a lot of people that understand the fundamentals of copper in the medium to long term, and know there's not enough projects to feed that pipeline. And so these projects have to be developed now, but the financing might not be from traditional sources. It might not be from retail. It might be private equity. It might be companies. It might be governments. Nowadays, because now we have this, critical mineral policy where copper or some other commodities are there, and they might be funding it. Like, Talon Metals got 110 million to help them advance the processing facility, which is not actually in Minnesota. It's actually in North Dakota, I think it is, or South Dakota,
Mm.
that they want to build a battery processing facility that would help, that they would bring their nickel to. So, and that would fit with the US's idea of disengaging themselves from China's processing of critical minerals. So that is real because we know how many projects are out there. We know what is getting permitted. We know where the capital is being directed. And we know the timelines to build and get them into production. So that we see going into 2025, and there's not enough. And the deficits are going to grow from 2026 beyond. And there's nothing we can do about it because we're basically set. And so that sentiment and the incentive for copper to go up to drive people to invest in it is really the issue right now, because Phelps Dodge, Freeport is sitting there with assets that they can invest in, like they're looking at, I believe it's I think it's El Abra, that they want to go and convert it from solvent extraction, electric winning to doing the sulfides. I think that's what they did at Cerro Verde. It's either that or reverse, one of the two. I can't remember, but that involves a lot of capital. But they're waiting, for the local government to basically stabilize. Yeah, I think it's Cerro Verde and it's Peru. They're waiting for them to stabilize their fiscal, policies, the taxes and the royalties before they do that. Same thing with BHP in Chile. They'd like to invest, but now they're sort of saying, okay, with this new left-wing government, make up your minds, because we're not going to do anything until you tell us what the structure is going to look like. And so for them holding back on expansions, we're not even talking sometimes on greenfield projects. We're talking about expansions that might already be in the forecast for some of these deficits that are planned, making the deficits even potentially bigger. And so you got to think about, well, where's all this copper going to come from? Where's all this whatever metal going to come from? And so that's why we need exploration, but we also need more development as well. So it's an interesting market right now, just because of all the dynamics that are happening, and new market players that weren't there before. The segmentation of the supply sources that are happening, with the U.S. saying it's got to be somebody, it's either local or somebody, we have a free trade agreement that really cuts out a lot of other countries, not only from the mineral point, but also from the battery components. So that has impacts on, hey, we're not going to get these vehicles from China. They're going to have to come from somewhere else like Korea or locally.
Yeah, copper is definitely an interesting market to me. I'm sort of maybe have a longer term perspective on it because it has so many moving particles that I'm not sure I completely understand. Because you have the above ground inventory, the stockpiles that are now down to historical lows of just a couple of weeks, and even what is it, 1.6 week or something along those lines, very, very low.
Yeah.
But then there's also shadow pounds and stuff like that people talk about that we don't really know about.
Yeah, the problem is, like, when I worked for Phelps Dodge and I was a market analyst for the copper industry, the visible inventories were just that, visible, and they were a higher proportion of the total inventories. And so they were a very good proxy for where the market was. As a lot of the processing moved from China being a bit player in the copper market to dominating it, and then being the largest consumer, I think 50% of copper is consumed there, then we have much less visibility into where those stockpiles are. So, but if you look at cathode premiums, and that's how much people are actually paying for cathode over and above the LME price, it can trade at a discount like it did back in March, but now it's trading at almost like $150 premium, suggesting that there's just not enough copper. But really, what's happening in the near term is not really impacting my thesis. My thesis is more about what's happening in 2025.
Okay.
I don't know what the demand's going to be like, but if everyone's talking about electric vehicles, if everybody's talking about carbon neutral technologies and the sort of electrification, the infrastructure required will need a lot of copper. And so I'm not worried about battery chemistry if I buy copper, or substitution, because aluminum is less conductive and requires even bigger diameter and more volume. And copper doesn't end up being a big part of the capital investment, but it's needed. And so my thesis in copper is more, let's say, medium term. But then I need that copper. So I need to know which projects that is. And now with what's happening with ESG, social issues, water constraints, you have to do a lot more work to say, is this project, even if I see that there's going to be a gap in copper, is this project actually going to come into that window? Because it might not even fit, because people might be way too much worried about water that these guys will never get the water they need, and they'll get it from somewhere else. I don't know. So the permittability of the project is very important in the current environment with drought conditions, all the way from, I mean, we had a drought condition in Vancouver, for God's sakes, but that's going all the way to almost a decade of drought in Chile.
What you're telling me about copper, in a way, reminds me of what my portfolio is exposed the most to, and that's uranium, because we have shortages in expected shortages. There's just generally a lot of the things that are true for copper seem to be true for uranium, with one big issue and one big question mark across it: is what is above ground inventory? We don't really know. What are the shadow pounds? Is there really a lot? Which one is? And so we don't really know much about that. What do you think?
But it's reflected. It's reflected, like in copper. It's reflected in the near term in copper premiums. It's not going to tell you how long the overhang is going to last, but that's one reason I stayed away from uranium, because nobody was signing long-term contracts, and the reason they weren't is they weren't going to commit to paying somebody a $50 per pound incentive price for long-term uranium, when they could get it at 20 or 15.
Right.
And so there was a lot out there that the power companies were very happy buying on spot. They didn't want to commit.
But that changed.
Exactly. That's changed recently.
Yeah.
As I read the quarterlies, I see companies saying, hey, we're starting to sign long-term contracts. And that, for me, changed about a quarter or 2 quarters ago. And so now they're worried. they're not only worried about where they're going to get their uranium because global stockpiles are going down, but the spot market has gotten tighter as well with these physical uranium trusts.
Mm-hmm.
That's taken some of the spot away. So now they need to commit to long term. But then also, if we have this market segmentation that suddenly, somebody says, "Hey, you can't get the stuff from Kazakhstan," that makes it a bigger deal. Where are you going to get that uranium from?
Mm.
And then also with Japan saying, "Hey, you know what? We might not put this stuff on the market anymore because we're going to use it." And then what's happening with natural gas might force Germany to say, "Hey, maybe we're going to have to go bigger on uranium," and that's going to create more demand. Because I think that China is sorting itself out for its own demand with the own assets that they've been buying in Africa and other places. But the rest of the world's got to start taking notice.
I absolutely agree there. I read that in Kazatomprom's Q3 operations report where they said that the spot market activity has been much lower, 40% lower this in the first 3 quarters of the year than it were last year, but at a much higher price. And then you look at the contracting market, much higher for this first 9 months relative to the first 9 months of last year at a much higher price too. They're also having production issues. They're having issues sourcing acid pipes and stuff like that they need to use for their well field developments today, which is going to show up in production next year, 8 to 10 months up in the future. So that was also an interesting development that I recently learned about in the uranium market.
Yeah, and so you can see that, and then with the market segmentation and all that other stuff, I think uranium is probably in a good spot. And so yeah, I do own uranium stock, but then if you own a development company, then the problem is like who's going to fund it, and now you can take the Chinese almost out of the picture for any North American based uranium or in Australia in terms of a takeout. It's just not going to happen. Because now Canada's saying we're not going to let foreign state-owned companies own anything to do with critical minerals in Canada.
Right. Joe, we've been at it for looking at my camera, almost an hour and a half. I don't want to take up your whole day. I really enjoy talking, but maybe we should schedule a second call. Whenever you have the time, you're a very busy man. You're here, you're there. Where do people go if they want to find out more about you? What do they look up? Which website do they go to?
Explorationinsights.com. And so there's a lot of free material on the website. You can take a look. But if you want all the site visit notes, the details of portfolio and what I'm doing, then that would involve a subscription, and that's about 140 US per month.
Cancelable. Okay. You also happen to be in Germany in the middle of November, I believe. What's that? That's some type of conference.
Yeah, that's the SOAR Financial Conference, and so I'm going to head out on a site visit to see some copper projects in Zambia, and then from there I'm going to head back to through Frankfurt.
Okay, awesome, Joe. I really appreciate your time. I'm sorry if I overstayed my welcome, but it was a great conversation. So thank you for being here.
Great. I hope your listeners enjoyed it. I enjoyed talking to you, and look forward to talking again.